There are some folks out there that want to argue once we have the death cross, which is where the 50-week moving average crosses over the 200, that signals the bottom, and then from there it's on the way up. And then there's other people that say, look, it's a 4-year cycle. No matter what, October 6th was supposed to be that day. Guess what? That was the top, and now it's just downhill from here. It's very natural. We'll be back in a year. What are your thoughts on these two statements? Welcome back to another episode of Network Spotlight. Friend of the channel here, Sebastian, is joining us from AquaNow. He's going to share with us what's happening in the markets and a few things around the AI bubble and some of the tweets that he's been putting out. It's definitely worth noting. So welcome, Sebastian. How are you doing?
I'm doing well, thanks. Choppy market out there, but still feeling pretty good about longer term.
I'm glad you are.
Prospects.
I'm glad you are, because we're at 95,400. I don't remember the last time I've seen these numbers, man. Everyone's calling for a bear market, and I think that's what everybody wants to know. Is this the 4-year cycle? Are we heading into a bear market? Is this just a small pullback before we, take the next leg up? I'll give you some perspective. Some folks out there that want to argue once we have the death cross, which is imminent here, which is where the 50-week moving averages crosses over the 200, that's kind of signals the bottom. And then from there, it's on the up. And then there's other people that say it's a 4-year cycle. No matter what, October 6th was supposed to be that day. Guess what? That was the top. And now it's just downhill from here. It's very natural. We'll be back in a year. What are your thoughts on these two statements?
I mean, they're both kind of like related to things that I don't focus on too much in my kind of like observation of the markets. Like I think like technical analysis is, I don't know. Like I get it. A lot of people follow it, and some people do well by it. Like a lot of the empirical research I've come across has kind of said it's pretty tricky, and there's so much nuance to it as well. So like I think it's great that if people have a system and it works for them, then they can go with it. But for me, it's not something that I like to focus too much on. Um, and then on the calendar side of things, same thing. Like I don't know that like markets move or institutional capital moves in a in a way that's like, oh, it's the 6th of October, that's the 4-year top of this 4-year cycle, dump your bags. That's not typically how professional money managers will allocate crypto or capital. So I think, suffice it to say, it's pretty obvious that like speculative assets have pulled back sharply, and that's generally uh, you know there's different participants in the market, and some of those are like algorithmic in nature, and so as speculative assets had kind of seen this nice kind of run for a while, and as a result, you get momentum algorithms or trading strategies that are meant to play like, oh, if it's going up, then buy it or hold it, and then keep doing it until that trend changes. And trend following is very popular in commodities and currencies and stuff like that as well. And
Real
then
quick,
when
Sebastian,
that
sorry to interrupt, but I'm just curious to know, like, do you feel like this is more of a, hey, there's an AI bubble, Michael is shorting, the big short, right? Everybody knows that story. Michael, forgot his last name, the one that shorted the real estate market. Looked like a genius, right? He's doing the same thing with AI now. So is that what is scaring the risk on assets? Or is it, I see here in your tweet, you posted that markets went from a certain height to basically 50-50. So is it the rate cut hesitation that has people weary?
Yeah, I think the macro kind of backdrop is a little bit precarious with the U.S. government being shut down, kind of liquidity being drained from the system more broadly. Like as I say in the tweet, I'm definitely not a macro expert, but I think it's pretty meaningful when even though Jay Powell said that the December cut is not a certainty, the market had expected there to be like a cut, and then with some commentary this week about like, hey, we don't know if we're going to be able to release any information. Then you probably then that's an indication that you maybe don't get a Fed rate cut. So you went from like 100 to 50. That kind of requires some repricing, and that kind of coincided with an already rolling over market from speculative assets as people were just a little bit concerned. And then if you scroll down, that will show this further here, where you've got bond volatility kind of spiked up. The yellow line there is the inverse of bond volatility. So when it moves down, that's actually volatility in the bond market going up. And then the white line is the Bitcoin chart. So you can see how a nice calm bond market had been coinciding with a nice supportive Bitcoin chart. That starts to get a little rickety, and then that changes, and that's kind of like a risk off type of move. So broadly speaking, you have like maybe waning momentum in some of these trading strategies coinciding with, oh, wait a minute, like maybe we've got to reprice our expectations for rate cuts as well. The bond market starts to move all in a time when there's not a liquidity in the space. You get big moves like this. But and I think this is a really interesting thing is we have this like short term versus long term kind of battle. So this is the U.S. Federal Reserve balance sheet. It had a little blip of increase back when there was some banking, Silicon Valley Bank and others kind of had some problems. But generally speaking, it's been in a downward trend for several years. The Fed representatives, including the New York Fed president, have commented like we're probably going to have to start going out and buying bonds again. So that's a very meaningful shift in trend, which I think is going to be more broadly supportive for risk assets. It's kind of fighting right now with this the issues I mentioned before, but nevertheless, that should be supportive longer term. And then if you keep scrolling down, here we have you know the monetary supply, sorry, M2 monetary supply, also trending higher, likely to invert a little bit, go even or change its slope even higher as a result of having to make accommodative policy to support some of the weakness out there. And then, so that's a positive continued trend. And then if you scroll down, we see the same thing kind of happening out of China with its central bank balance sheet expanding, and up and to the right. That should be supportive for risk assets. Again, with some chop along the way, but broadly that trend is still in place, like we saw with M2, and then now a reversal in trend with the Fed's balance sheet. So those are all really good. And I guess the main point here is we've got like some short term, call it noise, hitting, but like, the longer term fundamentals are still in place, and if anything, getting better. So great battles to see out there. I think generally speaking, people who have shorter time horizons or are more like trading oriented, would be like, oh, you want to be short in this kind of market, and it's like that's fine, but that's for them. I kind of like to think that underpinning digital assets more broadly, and some of these AI trends, which we'll talk about in a second, are these kind of more longer term trends.
So let's talk about the AI. It says your other tweet says the US is heading into a major power crunch. Morgan Stanley projects a 44 GW shortfall for data centers by 2028. AI demand is pulling every available megawatt into compute. What's the main message here with this chart?
Well, that's kind of like a more of a side, an interesting kind of like article that I read from Morgan Stanley this week, which talked about as AI is pulling all of the spare capacity and energy into to compute, as there's this like global race for AI dominance. What does that mean for Bitcoin mining facilities that use a very similar type of resource stack? And so in that instance, what they've found is there will probably be some displacement of U.S. Bitcoin mining equipment elsewhere. If you scroll down to the tweet, you'll see that I've got some comments there just from Google just saying like how much they need this. There might be some benefits of like better model design and improvements in like compute demand, like the demand for resources by improved models. But nevertheless, it's like that's going to take what 3 or 4 years, right? So there is a crunch right now. But we'll talk about it in a second. There's a crunch of more than just there's chips, there's resources and maybe now even capital, which we'll talk about. You're starting to see some of that those headlines come across in the market more lately. But keep going down, and then you'll see kind of the ultimate where I'm trying to go with this is that the Bitcoin mining map today, you see like a lot of the Bitcoin mining is in the U.S. As evidenced by those dots. I I suspect that if like the U.S. really wants to turn up the heat on like allocating all like possible resources that could flow into data centers, you might see some Bitcoin displacement, right? So we'll see. And that was kind of what Morgan Stanley had argued in their piece as well, because it is like a greater, broader social demand for AI right now. That was more of a side story this week than specifically on the trading specifically. But like I think with all of the fervor coming out there, people using the models, the Claudes and ChatGPTs of the world are fantastic. But now you start to see, okay, like, there's a lot of hype. Now what happens? And you're starting to see some limitations of how fast we can get to where people want us to, or where, like, the promised land for this for AI might be. So you've got chips are a bottleneck. We know that, right? So there's some limitations there, but general technology improvement suggests that we can kind of, like, keep the music playing as far as that's concerned. Then you have energy, right? So there's a lot of talk right now about, like, okay, so even if you build a data facility, that's got all of the racks and chips in there, like, how do you power that thing? Because there are limitations to the current grid, and then it's like, there are it's a matter of physics. You have to generate electricity and then run it into one of these facilities, and so that's another bottleneck. And then um, you're starting to see some question marks. Notably, everyone's talking about Oracle. So they had the CDS spread, or like the contract that um, uh, provides insurance cover if they were to default on one of their bonds. That increased a lot recently, because it's like, well, hold on a second. Like, Oracle has a lot of debt on the balance sheet that they're trying to use to fund their own AI ambitions. Like, you know, uh, what if people, like, stop giving them money, or what if people are worried about them not being able to pay their obligations? What does that mean for bondholders, and then ultimately equity holders? And so you have this kind of, like, now triple crunch of, like, chips as the underlying tech, energy to facilitate these things, and then capital to be able to continue the expansion. And so, that happens at a time when many people, as well as many algorithms, were all piling into the AI trade. And so there's, like, the speculative asset indexes or baskets had been jumping higher, and then all of a sudden you get this kind of reversal as a result of these questions, and then the momentum algorithms, if things flip, they just sell, right? They move, and so I think you're starting to see that here. That has a reflexive way of saying, like, oh no, now, like, it's like things are moving down. That's sour sentiment. So then people who had been committed by holders or buyers maybe have their conviction tested, and some of them get to selling, and that's very natural in markets. But yeah.
Sebastian, you also mentioned something earlier about Oracle and just people starting to like lose a little bit of confidence in them if they're not able to pay their debt. This leads me to this point here about the U.S. bankruptcies. This is the chart where it outlines the annual filings near 15-year high. Talks about the U.S. bankruptcy filings by year. I mean, we're starting to get up there in 2025.
Yeah, unquestionably, and this chart kind of made a lot of waves on Twitter this week as well. And like, obviously, it's not like great news. However, like, I think it's important to place it in context, right? Like, the U.S. has been or had been in a multi-decade period of free trade, or, like, generally, like, being open to trading partners, and, like, not being protectionist. That's flipped, right? And so when you have regime changes, it's like the economies have to adjust. As a result, unfortunately, that means that, yeah, some people lose their jobs, and some businesses that were geared for that old regime maybe don't survive. That's unfortunate. I'm not trying to make light of that, but, like, I do think that some of what you see today would kind of be expected, right? Like, if the world's largest economic engine completely U-turns on its policy of, like, of how it does global trade, some businesses are going to get caught up in that. So that's pretty interesting. And then there's also the possibility that AI is eating away at some of these businesses and or jobs, whereby, like, the success in AI means that, like, oh shoot, I had been paying this service provider for something, but I can do it now using ChatGPT. So I'm gonna not do that, and then maybe you have some businesses at the margin that don't compete. And actually, a quote from that chart, from that report, that I thought might suggest that is, majority of these things are coming from industrials, consumer discretionary, and healthcare. So healthcare, I can't speak to specifically. Like that one might be related to funding and some concerns there with the changing government. But industrials and consumer discretionary are like right at the crux of like importing goods, as well as manufacturing and stuff like that that may have been geared to the previous regime. So again, like, I just read the article like you did, but I mean, when I first saw that bankruptcies are at their all-time high, my initial thought was obviously like we're living through a pretty dramatic shift here. And then when I kind of read through it and saw that those were the sectors that were hit, I was like, maybe that makes sense as well. So we'll see.
I read somewhere a while back that a good way to tell about the current state of the market is by looking at the boat sales.
Yeah, like discretionary items like boats or ATVs and stuff like that are probably pretty good indications of that. Sometimes it can be a bit hard to see because there could be like technological shifts or like, oh, there's this brand new boat that's awesome, and so some people are into
Yeah.
that. But I think consumer discretionary is a good way to look. Well, we'll see. Like it's kind of hard to pin like short-term data points on like longer-term trends until you see something that like is really indicative of an inflection point. But I think, generally speaking, it's okay. I really do kind of believe this idea that like, as you mentioned Michael Burry earlier, I
Yeah.
think a lot of people watch The Big Short and or read the book, and then they're all kind of looking for the next opportunity to be the people who stand out and be like, hey, I told you so. Um,
Yeah,
but
and everyone's
yeah.
obviously familiar with the movie too, and so there's a lot of I think if anything it just created a lot of panic.
Yeah, no, I totally agree, and I think that a lot of people read that and they're like, "Oh, I'm going to be contrarian and like sniff out the next exuberance." But I would encourage people to watch that movie again and then like just go and see just how exuberant that was, like with respect to like people owning homes, empty houses, and so on and so forth. Now, when Michael Burry rings the bell on stuff, it's worth listening to. He's obviously like a pretty prolific fund manager, was right on the housing crash, has had some incorrect forecasts or bad timing on some other calls, but like like I think you want to have like you don't want to like you know um make oracles of people. It's important to like update your own prior or your own thesis around how things are going, and we'll see, right?
Yep. Yeah. Do you have anything a quick synopsis about what you mentioned here on this tweet? The punch bowl was empty?
So yeah, I think generally speaking on this tweet here, you can see a lot of the previous kind of like hot sectors, Bitcoin, momentum, as well as speculative growth, all kind of rolling over. I make the point that the punch bowl is empty. That being like liquidity kind of has been drained, and the proverbial music at the party has stopped. But if you scroll down, I think what the reasons I kind of have a bit of a joke there as to why I think we'll get back, right? Politicians ultimately want to stay in their jobs, so with midterms coming up, I think we'll have some friendly conversation or some friendly rhetoric coming from the White House and other maybe governments as well, and central banks will step in if things get really bad, which will be kind of like which will avoid the system situation. So I think it's important to watch what the Fed is talking about these friction, how they're talking about these friction points, if they mention any concerns. So like watch the Fed talk over the next little while, see what kind of data we get coming out of the government reopening, and maybe change in rhetoric from them as well. And
Yep.
then, to the extent that the U.S. Treasury kind of, makes some actions as well, then that'd be something to keep an eye on. We'll see how fast things can get back to, how fast the markets get back to finding their footing.
Thanks, Sebastian. That's a good place to end it here. If anybody watching here, if you enjoyed the content, please subscribe to the channel, like the video, and I'll have Sebastian's links in the description. He's on X. He also has a great Substack. I'll include all that in the description. Thanks again, Sebastian. And we're going to do this every week, so we'll catch you guys in the next episode.
Sorry.
If you're a founder or operator in Web3 and want to connect with others like you, head on over to networkspotlight.io and apply to become a member. See you on the inside.